Royal Gold, ticker RGLD, missed consensus for Q2 2026. Adjusted EPS came in at $2.56, which missed the $2.62 estimate. Revenue hit $450.54 million, missing the $457.97 million estimate.
And management reaffirmed their full year 2026 sales guidance. So that's 290,000 to 320,000 ounces for gold and 3 to 3.5 million ounces for silver.
Right. While also noting that copper and other metals are tracking at or above the very top end of their guidance. But here's the wild part. The market completely shrugged off the miss.
Totally ignored it.
Yeah, shares were flat in after hours, trading at $215.54, but then by the pre-market, they had actually bumped up over 2% to $238.40.
Which is pretty crazy. I mean, if you're looking at your portfolio right now and wondering why the market didn't punish the stock, you are definitely not alone.
Exactly. I mean, if this were a top and bottom line miss in the tech sector, it would be an absolute bloodbath.
Oh, yeah.
We're talking double-digit percentage drops at the opening bell, aggressive sell-offs, panic, the whole thing. But Royal Gold didn't just survive this double miss, they rallied.
So now that you have the headline numbers, our mission for this deep dive into Royal Gold's Q2 earnings call and the institutional research around it is to unpack why. Why did the market give them a total free pass here?
Well, it's because institutional investors looked right past that minor revenue miss. Because, if you run the math, it was only about 1.6% off the consensus estimate.
Barely a rounding error, really.
Right, and they focused squarely on the structural cash generation underneath all those numbers. What's truly fascinating here is the operating cash flow. It hit an absolute record of $335 million for the quarter.
Which is up 119% year over year.
Exactly. When a company is generating that kind of physical, tangible cash, an accounting miss on adjusted earnings just becomes, background noise to the big institutional players. Yeah, the market basically realized that the slight top-line shortfall was simply a matter of timing. Minor discrepancies in analyst modeling, not some fundamental flaw in the business itself.
No, the business is humming.
Okay, so let's unpack the mechanics of that. To understand how Royal Gold generated a massive $335 million in cash despite technically missing the earnings mark, we have to look under the hood at their top-line revenue surge.
Because even with the miss, revenue was still up 115% year over year.
Right. We need to dissect the volume and the commodity prices driving it.
Well, the volume is a great place to start. Total volume reached 100,000 gold equivalent ounces, or GEOs, for the quarter.
And just real quick, for those of you tracking their total output, since they sell silver and copper to GEOs, are just a standard math trick the industry uses.
Right, it makes things so much easier to compare.
Yeah, you basically calculate how much gold that silver and copper revenue could have bought, and you report it all as one unified gold metric. It just makes the apples to oranges comparison actually work.
Precisely. And within that 100,000 GEO volume, we saw stream revenue completely dominate. It came in at $311 million, while royalty revenue came in at $140 million.
Let's clearly separate those two for the listener because, they are very distinct engines for the business.
They are. So a stream is an agreement where Royal Gold gives a minor upfront capital. And in exchange, they get the right to purchase a percentage of the metal produced at a fixed, deeply discounted price in the future.
Got it.
A royalty, on the other hand, is just a straight percentage of the revenue from the mine's production. There's no ongoing purchase price required for that. But both models share one crucial trait, which is they keep Royal Gold heavily insulated from the daily operating costs of the mine.
Right, which is huge right now. And their mix remains highly focused on precious metals, right?
Yeah.
Like 76% gold, 12% silver, and 8% copper.
Yeah, and that mix is vital when you contextualize those volumes with the exploded realized prices we saw in the second quarter. And this is where the cash generation really accelerates. Royal Gold realized an average gold price of $4,506 per ounce.
Wow.
Yeah, that is up 37% year over year. Silver realized $73.15 per ounce, which is up a staggering 117%. And copper hit $6.05 per pound, which is up 40%.
Just think about this for a second. Silver prices more than doubled for them. But because of the mechanics of their streaming agreements, their fixed cost to acquire those silver ounces barely changed at all.
Exactly.
That is the magic of the streaming model. 100% of that massive price spike drops straight through to their bottom line.
That is the exact aha moment investors need to grasp here. When you pair a 56% increase in GEO volume jumping from roughly 64,000 GEOs last year to 100,000 this quarter, With those kinds of macro commodity tailwinds and fixed costs, the cash flow generation becomes exponential.
Unbelievable. But beyond the macro tailwinds, there was also a very specific operational quirk that padded the top line this quarter. The earnings call detailed a $22 million revenue bump stemming entirely from the Relief Canyon settlement.
Oh yeah, this is a great example of management optimizing their existing agreements.
Basically, they advanced a 5,000-ounce gold delivery from America's Gold and Silver. Originally, that delivery was scheduled to be spread out slowly at roughly, 275 ounces per quarter, stretching all the way through the end of 2027.
Right.
But instead, they just negotiated to take it all in the first half of 2026.
And that settlement accomplished a few things. First, it eliminated a cumbersome, complicated arrangement for both Royal Gold and the operator. But more importantly, it pulls that cash forward into today's incredibly high price environment.
Right, they get to sell that gold at $4,500 an ounce today, rather than risking
what the price might be in late 2027.
Yeah.
Exactly. And they did this without impacting their underlying long-term royalty or stream interests at Relief Canyon. It was a one-time benefit to Q2 revenue, absolutely, but it perfectly illustrates management's obsession right now, which is ruthlessly cleaning up messy arrangements to maximize cash flow.
But wait, cleaning house is easy when you are flush with cash from $6 copper, which actually makes me wonder about their broader identity here. I kind of have to push back on their strategy.
Okay, let's hear it.
With copper prices up 40% and copper sales tracking at the very top of their 21 to 25 million pound full-year guidance, shouldn't retail investors start viewing Royal Gold as a backdoor copper play? I mean, copper is now 8% of their revenue, and their Antamina net profits interest royalty is clearly outperforming expectations.
It's a totally logical question to ask when you see a base metal generating that much surprise cash. But management was incredibly definitive on this point. During the call, CEO William Heisenbuttel stated directly, "Copper's not suddenly a strategic metal for us."
Huh. So they're actively rejecting the idea of a pivot?
Completely. Royal Gold is strictly maintaining its identity as a precious metal streaming and royalty company.
Oh, yeah.
You mentioned the Antamina Net Profits Interest, or NPI.
Yeah.
For those tracking the specific asset types, an NPI means Royal Gold gets a percentage of the profit only after the operator deducts capital and operating costs. The recent surge in copper revenue from Antamina is largely driven by lower than expected cost deductions by the operator, paired with that $6 copper price.
Oh, I see.
Right. Add in strong performance at assets like Mount Milligan, and it creates a fantastic revenue bonus. But they're still 76% gold. They are not shifting their corporate strategy to chase base metals, even if the current pricing environment is highly favorable.
So they are happy to collect the copper cash, but they are staying completely disciplined on their precious metals identity. And that discipline is exactly what brings us to how they are actually managing all this record top-line revenue.
Yeah, because generating cash is one thing, right?
Exactly. Translating that into balance sheet strength and shareholder returns is another thing entirely. Let's look at the margins. Their adjusted EBITDA margin is sitting at an incredibly high 83%.
I mean, that is essentially a software company margin, not a mining margin.
Exactly. Net income hit $236.4 million. And because that margin is throwing off so much cash, they're aggressively deleveraging at a blistering pace. Like, they repaid $200 million on their revolver just in Q2.
Just in one quarter.
Yeah. Then they paid down another $75 million in July, and they are planning another $100 million repayment in mid-August.
The velocity of that debt repayment is remarkable. Think about the timeline here. They ended 2025 with nearly $900 million in debt after finalizing their major acquisitions of the Sandstorm and Horizon asset portfolios.
Right.
By mid-August of 2026, in a matter of months, they will have paid that down to roughly $325 million. Their stated goal is to reach zero debt by Q4 of this year, and total available liquidity is now sitting at $1.2 billion.
That's wild. And while they are wiping out the debt, they aren't ignoring the shareholders either. Capital returns this quarter included $40 million in dividends and a $30 million buyback, which canceled over 147,000 shares.
And all of this is funded entirely from internal cash flow.
Let's break down the mechanics of how that is even possible because, traditional mining companies simply cannot aggressively pay down debt, buy back stock, and pay dividends all at the exact same time without borrowing more money.
Yeah, to understand the mechanism, you kind of have to think of a traditional mining company like owning a large, complex restaurant. If the price of ingredients goes up, or the oven breaks, or the staff demands higher wages, your profit margins vanish instantly. You have to constantly pour capital back into the business just to keep the doors open.
But Royal Gold doesn't own the restaurant.
Exactly. Royal Gold just bought the rights to 5% of every stake sold forever.
I love that analogy.
Right. If the oven breaks, the mine operator has to buy a new one. If diesel prices spike, the mine operator pays for the fuel. Royal Gold just sits back and waits for the steak to be served. Because Royal Gold is a streaming and royalty company, the acquisitions they made in 2025 are now cash-printing engines that require zero ongoing capital expenditures from them to maintain production.
Wow.
The mining operators bear the entire burden of labor costs, inflation, and sustaining capital. Royal Gold simply collects its percentage at the top line.
And that structural advantage is exactly how they can maintain an 83% EBITDA margin and completely wipe out their debt. But, that lack of ongoing capex brings us directly to management's strategic focus this quarter, which was cleaning up the complicated assets they inherited from that 2025 Sandstorm acquisition.
Yeah, this is where the strategy really gets tightened up. During the call, management highlighted their extreme diversification. No single asset in their portfolio is contributing more than 13% of total revenue.
That's really well balanced.
It is. In fact, only 2 assets even generate more than 10%. That severely reduces their concentration risk. If one mine goes offline, it doesn't sink the company.
But the biggest strategic move they made to clean up the portfolio was the Hod-Maden joint venture restructuring. Royal Gold reduced its direct equity stake in the Hod-Maden project from 30% down to 15%. In exchange for giving up that equity, they received a new 2.5% net smelter return, or NSR, royalty.
Which was a critical restructuring event for them. When they acquired the Sandstorm portfolio last year, that 30% direct equity stake in Hod-Maden was a massive outlier. It fundamentally did not fit their traditional streaming and royalty model.
Okay, hold on. I have to challenge this logic because this is where a lot of retail investors get confused. Hod-Maden is widely considered a high-grade, highly profitable Tier 1 project.
Sure.
It's targeting initial concentrate production in 2028. If gold is sitting at $4,500 an ounce, a 30% equity stake in a Tier 1 producing mine is an absolute cash geyser. Why give up half of your equity right before it actually starts producing? Isn't management just leaving massive future upside on the table?
Well, it absolutely looks that way if you view them through the lens of a traditional mining company. But you have to view this move through the strict lens of a streaming and royalty firm. Direct equity means direct exposure. It exposes the company to capital cost overruns, localized inflation, and operational risks.
So, if the price of steel goes up to build the mill,
An equity owner pays for that out of their bottom line. If the operator struggles with labor negotiations or permitting delays, the equity owner absorbs that financial hit. By converting half of that equity into a top-line net smelter return royalty, they insulate their balance sheet.
I see.
An NSR simply takes a percentage of the gross revenue from the metals sold, regardless of what it costs the operator to pull it out of the ground.
So they basically traded a piece of potential operational upside for absolute protection against mining inflation.
Exactly. They are returning to their low-risk core business model, and it shrinks their remaining capital commitments drastically. Based on the $900 million project estimate for Hod-Maden, reducing their share to 15% leaves Royal Gold with only about $65 million left to fund over 2027 and 2028, especially since they already funded $70 million this quarter.
Which, for a company generating $335 million in operating cash flow in a single quarter, a $65 million capital commitment spread out over 2 full years is essentially immaterial.
Exactly. It completely de-risks the asset from a corporate liquidity standpoint. They still have some upside through the 15% equity, but they've drastically limited their downside exposure to actually building the mine.
Okay, that makes sense. But despite the strategic cleanup and the massive cash flow, this deep dive must address the margin pressures and operational risks that analysts are flagging in the background because, the quarter wasn't entirely perfect.
Okay.
Let's look at the costs. Depreciation, depletion, and amortization, commonly known as DD&A, spiked to $96 million for the quarter. That translates to $962 per GEO, up sharply from just $487 per GEO last year. Also, general and administrative expenses, or G&A, are tracking near the high end of their $50 to $60 million full-year guidance.
The G&A is definitely something to monitor, but the DD&A spike is what caught a lot of attention.
And I actually want to push back hard on that DD&A spike. A near doubling of the depletion cost per ounce, going from $487 to $962. You're telling me I shouldn't care about that because if I'm an investor looking at their GAAP earnings, that looks like a massive hitting red flag that will perpetually eat into their bottom line. Convince me it's not a fundamental problem.
Okay, it absolutely eats into their GAAP earnings, yes. In fact, it is the primary reason they missed the EPS estimate we talked about at the top of the show.
Right.
But it is not a red flag for the actual health of the business, because this raises an important point about how acquisitions are treated in corporate accounting. The DD&A increase is a non-cash accounting reality.
Explain the mechanism there. Why did it double?
Well, when Royal Gold acquired the Sandstorm and Horizon assets in 2025, accounting rules required them to bring those assets onto their balance sheet at fair market value, which is a significant premium. As those newly acquired assets start producing ounces, the accounting rules force Royal Gold to amortize, or basically write down, those higher carrying values over time. It is just a mathematical formula on a spreadsheet that heavily reduces net income, but it does not cost the company a single physical dollar in cash.
So it makes the on-paper EPS look worse, which is what triggered the headline earnings miss, but the actual bank account just keeps growing.
Precisely. The true risk for you to monitor as an investor isn't the accounting depreciation, it's their reliance on third-party operators. Because they don't own the mines, they don't control the operations. For example, management mentioned ongoing silver recovery optimization challenges at the Pueblo Viejo mine.
Right. If the operator there struggles to optimize the mill, Royal Gold simply gets fewer silver ounces delivered. They have no operational control to send in their own engineers and fix it themselves.
They are completely at the mercy of the operator. However, the fact that no single mine accounts for more than 13% of their revenue acts as a really powerful shock absorber for this exact risk. If Pueblo Viejo has a weak quarter due to recovery issues, strong outperformance at Mount Milligan, Antamina, or Greenstone basically absorbs the blow.
And that diversification is exactly why institutional analysts actually upgraded their models after the call, despite the GAAP earnings miss. Like, Scotiabank's Tanya Jakuskonek raised her fiscal year 2026 EPS estimates for Royal Gold to $10.79. That is well above the prior $10.32 consensus.
Yeah, those analyst upgrades are telling. They prove that Wall Street is looking at the underlying cash mechanics, the de-risking of assets like Hod Maiden, and the massive diversification rather than getting bogged down by non-cash accounting adjustments. The downside is firmly capped by the breadth of the portfolio, while the upside is fully exposed to $4,500 gold.
Right. So to synthesize everything we've covered today, Royal Gold's Q2 2026 report looked like a double miss on paper. But under the hood, it was an absolute masterclass in structural cash generation. We saw aggressive debt reduction, charting a very clear course to zero debt by the end of the year, and risk-mitigating diversification that successfully insulated the balance sheet from the brutal reality of mining inflation.
The underlying mechanics of the streaming and royalty model are just firing on all cylinders right now. It's allowing them to capture record commodity pricing without the capital exposure that traditionally plagues the miners actually digging the rocks out of the ground.
Make sure you follow the show for your daily dose of rigorous earnings coverage just like this. We cut through the noise, explain mechanics, and do the heavy lifting so you don't have to.
Exactly.
But before we go, consider this final thought. If Royal Gold is on track to completely wipe out its debt by Q4 2026, while currently generating a record $335 million in quarterly operating cash flow, what exactly happens to all that excess cash in 2027? If these high metal prices hold, will retail investors see a massive, unprecedented special dividend, or is management quietly building a multi-billion-dollar war fest for a mega acquisition that could reshape the entire streaming sector? Keep a very close eye on that cash pile.